Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's program, the CEO of Domain, Jason Pellegrino, answers a few questions, and I asked the question, is this company really worth buying considering we're in a property boom? And then Investor Mutual's Hugh Giddy pinpoints the defensive stocks he likes in this volatile market. Then the CEO of BHP, David Lamont, really makes you want to buy BHP. It gives me a lot of confidence that the share price can keep going, but more importantly, the dividend looks pretty well stuck. They're going to keep on paying real good dividends, at least for the next year. And finally, Paul Rickard looks at the companies that have reported this week, and we ask the question, are they buy, hold, or sell companies? That's the show. Let's kick off now with the CEO of Domain, Jason Pellegrino. Jason Pellegrino, thanks for joining us.
Thanks for having me.
All right, mate. I've gone through your numbers. Revenue up 27.4%, net profit up 2.4%, and the market's giving you a bit of a sell-off today, down 6.4% as we talk. Why is the market so negative on the company at the moment?
Look, I mean, it's difficult for me to point to specifics of market behaviours on a single day.
Yeah.
We've seen extraordinary strong response over a number of years, and the numbers today, I think, are a really high quality set of results that underpin what we've been focused on over the last 3 years, which is really through 3 of the most complex years in the Australian property market. We have transformed the business, and we've been setting the business up for the success to benefit from the inevitable listings return, which did happen in the last 6 months. So a 27% revenue increase, 53% increase in underlying EBITDA. There is still some complexity in our numbers that rolling out of COVID. There is timing of JobKeeper. We took JobKeeper in the middle of COVID, but our performance warranted. The right decision for us was to pay that back, and we did. That just happened over 2 separate financial years. We implemented a zipline scheme, which was an employee share for cash salary swap in the early parts of COVID, and those impacts are sort of one-off timing impacts that are not ongoing. So if removing the impacts of those, which are very material, they benefited our cost base by $8 million or more in the prior comparable period, and then the cost of that was over $8 million in this financial period. So there's a $16 million swing, which is incredibly material.
Yeah,
we're from the numbers, we're up 53% year on year in terms of EBITDA, and an even greater growth in net profit and to shareholders.
Yeah, well, obviously in my job, I got to try and work out why the market reacts a certain kind of way, and we instantly went to your rival REA, and they've been clobbered over the same period as well. So you start thinking, well, what could be the cause of why the market is not really appreciating the improvement in the business? And one argument might be interest rates are set to rise, but really they're not rising at the moment apart from fixed interest rates. And the supply of houses coming on the market really should be a good thing for you guys, because that would mean more ads. Is that a fair analysis?
That's a fair analysis. Look, the thing that I find quite amusing is there's a lot of commentary out there of stocks and opportunities, and whether it's IPOs or in the private market of, this could be the next Domain, this could be the next REA, this could be the next Seek. I actually think the next Seek, I think the next Domain is actually Domain. I think it's Seek. I think what broadly based speaking is people are, I don't think they're actually understanding the quality and resilience of these classified business models, their ability to actually expand into broader based marketplaces. The resilience of the revenue and the profitability. If I look through over the last 3 years, extraordinarily complex environments for jobs, cars, and real estate, and on a global basis, and yet these businesses have continued to deliver growth in revenue and profitability. And as these markets and economies coming back, we're seeing an acceleration of these parts. Looking forward, I'm actually incredibly excited about the opportunities that lay ahead. So it's not for me to predict stocks. I've done that in a prior evolution of my career. I'm not good at it. What I am good is at running a business, and the reality is I'm really excited about the Domain business.
Yeah, well, I know you can hide behind the fact that you got to run a business, and the most important thing is to run that business really well. But for me, I've got to try and keep flushing it out. It seems also to me, and tell me if this is a fair call, that you're probably being lumped into the tech stock category, and a lot of good companies that are tech stocks have been sold off primarily because they are a digital business.
Yeah, and I think the growth to value rotation, the inflation aspect, these sectoral rotations, these are powerful drivers. And to be fair, I would say there are so many tech stocks in the early parts of COVID or through that period that benefited from this. So, there are swings and roundabouts in this industry. What I think is quite interesting, though, is we are absolutely a technology business, but we are a high growth revenue, high profitability and high growth in profits business. We're not a business that is actually trading on a revenue multiple or looking for unknown parts of profitability.
Correct. Yeah. And I think in many ways that's what investors should be looking for. Another aspect which I think a lot of people don't understand is that really, because people say, oh, well, prices boomed 22% or so last year, and prices are expected to rise by a smaller amount next year, and then fall if you believe Westpac, 14% in the year after. But does falling prices necessarily mean you earn less revenue? Because it's all about ads on the website, isn't it?
Look, we have transformed our business over 3 years. So 3 years ago, 18% of our revenue, over $70 million of our annual revenue was out of print. Yeah. In the last half, that's down to 6% of our revenue. We've dealt with the structural trends of print, and we replaced that with higher quality digital listings revenue. So that revenue, it's not dependent on pricing. It is dependent on listing volumes, but we hold ourselves accountable to what we call controllable yield, which is for all the listings that are out there, what is the price we're selling products for, and what is the uptake of those products across, our agent community, for example. And in that instance, we've accelerated controllable yield from 6% year on year 3 years ago to 19% in the current year, and that's independent of listing volumes. So going forward, the reality is our business performs at its best in relatively stable, sort of slow, sort of single-digit increases in price and decrease in price. Whenever you get large swings, that's when you all of a sudden get a sense of lack of confidence or uncertainty, and it does slow down people's decisions to bring property to market. You got to remember, most people who are selling property are also buying property. That's the highest volume transaction. And so whether it's a fast rising price or a fast falling price market, that does make people's decision to sort of buy hesitant, and then their decision to list. Yeah.
It would seem to me, Jason, even though you've been in the business only 3 years, I'm sure you would have looked at the history of property businesses. It seems to me the biggest challenge would be unemployment. Big unemployment would really hurt a business like yours. And looking at forecasts, it's going to be a long way off before we see something like that.
The vast majority of property transactions in the country are driven by demographics. It's births, deaths, marriages, it's new jobs or loss of jobs. It's the divorces, it's the new marriages, it's kids, like all these elements. Now, over the last 3 years, listing volumes did contract significantly because of lack of confidence of job security, all these sort of elements. But those demographic movements are still there. And so what we've seen in the last 6 months is essentially a catch-up of this sort of missed transactions or missed listings in the last 3 years. Yeah, a good example, if you are a couple with one child in a 2-bedroom unit and another child coming along, you do need extra space. If through a divorce, you can hold on to a property, but eventually it needs to be sold. If you have a new job, you can rent for a period of time, you can commute for a period of time, but eventually you need to, enter into a transaction. And that's what we're seeing. So actually we are facing, and what we're seeing in the market is a catch up of missed transactions over the last 3 years. But on top of that, those demographic drivers have actually accelerated. People are looking at and revisiting what home means for them, what work means for them, what flexibility of work and commute patterns mean. And so that's why it's an incredibly exciting period ahead, I think, in terms of the market opportunity around listing volumes and transactions. The other opportunity is that, we're moving beyond listings. We've got a great mortgage business. We've got a great property data business to help, governments, to help financial institutions really understand property data and the impacts of these patterns and behaviours. And that's opened up Domain's opportunity to brand new markets with considerably larger TAMs than the advertising market.
Yeah, okay. And if you hadn't paid back the JobKeeper, what would your net profit look like?
So that the swing there was adding that back $8 million just in the half. So that's really that's a material amount if you think about the dollars that the net profit for the half. $8 million is incredibly material.
Yeah. Wouldn't you love shareholders to reward you purely on the basis of how nice you were to the government coffers?
Well, look, I think at the end of the day, it was the right thing to do. We took the benefit in a period of deep uncertainty. It did provide us with security and confidence, and it was through there. But what transpired after that was not property price declines, or was actually increases. And what transpired out there was our ability to run the business well. What transpired is our employees stepped forward into Zipline and decided to take, over 80% of our employees took up equity in Domain, and they're now owners of our business, which is extraordinary in an ASX context. So, a lot of benefit for there. We thought the right thing to do was actually to repay that business. Unfortunately, accounting requires us to recognise the cash flows in different halves, but overall, we look through that to the underlying business.
But I guess you therefore could probably say with pretty good confidence, as long as revenue holds up, you should be looking at a much bigger net profit come August, October.
Yeah, and I think this is where those timing differences go through. You either adjust for those now, or you'll see them in the later period. What we're saying is, let's adjust for them now. This is the underlying performance of the business. We're not going to take double credit of that for that in our next period. We'll also report on those adjustments, because we really want to focus on the underlying performance of our business rather than just accounting and cash flow impacts that are just one-off and are completely independent of the performance of the business.
Okay, mate. Thanks for joining us, and well done, and good luck going forward.
Perfect. Thank you.
With the market under a bit of challenge at the moment, we're talking to Hugh Giddy, who's Senior Portfolio Manager at Investors Mutual. Hugh, thanks for joining us.
You're welcome.
Were you expecting the volatility this year?
It's very hard to ever forecast, what the stock market's going to do.
Yeah.
As to the likelihood, certainly that was much higher because valuations are so stretched. And I mean, last year you could see inflation getting out of hand, and eventually you thought something's got to give. Central banks can't keep their head in the sand and say, oh, it's transitory, it's going to go away, because inflation's, if you look at where inflation is now, at 7% in the US and interest rates of 0, that's a negative real rate of minus 7% is unprecedented.
It's unbelievable, yeah. Okay, so and we all know once rates take off, it unnerves the market, at least in the short term, and we'll talk about that later.
Sure.
But what is, like, if we give the time period of 2022, do you think that the market will be higher at the end of this year than it is now? Now it's a guess, and don't say it's a mug's game to try and tip the market. You have to give it an answer. Do you suspect that the way the things will actually work over the course of the year, that stocks can go up?
It's funny, my cheat sheet was, to that question, it's a mug's game to forecast the market.
Yeah,
but
that's a cliche.
It's fair to say that I believe overall, there's a good chance that the market ends the year lower.
Yep.
However, that's the index. You can still make money in selected stocks, but overall, valuations are very high. Interest rates going up are normally not good valuations. They're not that great normally for the economy improving, getting stronger.
Yep.
When you've got a very, very financially based economy like Australia, the first world, a lot of developed countries, the financial sector is very, very big. The low interest rates are helping private equity, venture capital, as well as banks and stock market and pension funds and so on. There's all that other sort of part of the economy that relies on cheap finance.
Yeah, and the tech stocks have been a case in point.
Well, they've been huge beneficiaries of low interest rates, but they've also been beneficiaries of COVID, of lockdowns and so on. You know, I mean, mom and pop store had to close, but Amazon, some online retailer didn't. Costco didn't have to close because they sell food, but someone else did who sold other general merchandise. So it really
flowers on Valentine's Day last year. It was a very big issue in Melbourne. I think they actually closed it down on the day of Valentine or day before, and so many flower shops ended up with flowers they couldn't get rid of. Anyway, that's the past. We're looking at the future here, mate. Do you think the market's going to be rattled by what the Fed might do with interest rates in March, particularly if they go for a 0.5% rise first up?
Hard to know. I mean, it's already being built into expectations. So I'd say it's very likely to happen because the Fed tends to, if you look at Fed actions, they often mimic what's already happened in the forward markets.
Yeah.
So it's not such a surprise. I suppose I don't think that the market always follows the news. I'm one of those people who feels journalists have to write a story, and so there's always an explanation for why the market rose or fell. And sometimes they say the market went up with the oil price or something, and then it fell because high oil prices caused people to worry. That sort of thing. So whether it's about the Fed action, I'm not sure. But what I do know is that part of the reason valuations are so high is there's this very firm faith that the central banks are going to navigate this and that there's always there to back up the market because they've held interest rates too low for so long and that's really pushed up financial assets. But I personally think central bankers are about as competent as Chairman Dan is logical. Not very.
Okay, right. So, given that setting, and I personally think interest rates, how many we get in the US, how fast they rise, and then the course of Omicron. If Omicron dissipates quicker than we think, and inflation starts coming off the boil, that could be a good scenario if the Fed doesn't raise too quickly. But on the other hand, if they raise too quickly and Omicron is still causing supply chain problems, well then I would agree with you that the market could be down at the end of the year. So that's my best guess.
Fair enough.
Given that two alternatives, what stocks do you think look like good value? Which ones do you think, for the current share price, are a good buy right now?
Well, in terms of specifics, in general terms, I'd be avoiding commodity exposures, even though you'd say high inflation, great to be in commodity exposures. The thing is, I think that commodity prices are quite high, and we've seen before how rapidly they can fall. So I'd sort of be avoiding that, even though I'm worried about inflation. I'd be into more defensive things because I think that central banks have to act against inflation. So more quality defensives. In amongst those, I would highlight Horizon. They reported yesterday, and they have very strong cash flows, a very good dividend. They're a little bit out of favour because people who are worried about climate change don't like the fact that they rail coal as part of their business.
A big coal supply.
But it's a very, very strong cash flow business. And and a very high yield and cash flow yield, and a good balance sheet.
Good dividend payout.
Yes. The dividend they've cut a bit because they did this one rail acquisition, but it's still paying a good dividend, fully franked, and backed very much by cash flow. The yield still as good as what you could earn in a bank, which I believe is more risky.
Really. Better than the bank.
Better than a bank. And certainly more than you can earn in a term deposit in a bank or something, but better than a bank share is what I meant.
Okay.
And then I'd talk about Orica, which is less of it's a little bit more of a cyclical business, but not that cyclical. They're really exposed to mining volumes rather than the commodity price itself. They're the world's leading explosives company. They've got the leading technological offer in explosives with a wireless blasting offer that can really raise miners' productivity. And this balance sheet's strong, but they have been hit by COVID, few mine closures and so on, and that means no mining operation, no blasting, no explosive use. New management that I think is doing quite a good job. World leader, not expensive. I think that, and it's not really about the economy. It's about mining volumes, which, given where commodity prices are, either they're going to, it's hard to see mining volumes falling. Even if commodity prices fall, miners don't stop mining.
Yeah, so I guess what you're saying is that even if the commodity prices start to fall away, it won't be because there'll be a lack of demand. It could be an oversupply reason behind it, because otherwise they won't be blowing up as many pieces of dirt. You sort of mean like...
Yeah. There could be a small fall in demand, but a small fall in demand can be magnified in the commodity price.
Yeah.
But commodity prices aren't always about supply and demand. The paper transactions, the financial transactions in oil, swamp, the actual transactions of people who want oil for their refinery and are selling oil from their well. There's a lot of financial speculation that goes on in commodities, futures contracts and so on, people who are never going to take delivery of the physical commodity.
Okay. What kind of dividend does it pay?
The dividend, the balance sheet's strong. The dividends has been depressed because of this COVID thing, but the yield's 3-4%.
Okay, so both the stocks you've mentioned are reasonable for dividend players.
Yes.
Do you think it's going to be a good year to be defensive with reliable dividend-paying stocks?
I do.
Yeah.
Look, if I believe the market is going to be quite challenging and choppy, then at least if you're getting a dividend, that's giving you part of your target return. I think investors should be targeting over time a return of 8 or 9% because that's what you've historically got. If you want to keep up with inflation at the moment, you're looking for a bit more, but maybe that's not so easy. Just inflation doesn't gift you a higher return. Normally actually means a lower returning market.
In real terms.
So yeah, I'd say it's good to have that put the dividend in your back pocket and hope you can make some capital gain along the way too.
So the fund that you're most responsible for, what's the investment strategy? What's the investment theme?
We buy quality defensive companies, quality value companies. We've got to look at the price, what's the valuation, but first and foremost, you want to buy something quality. It's too easy to buy something that looks cheap, but it's cheap for a reason. That's the classic value trap, and there are countless value traps always available in the market that sort of look good, but then you look at the track record of the company or the track record of the management, and you realize, it's a 50-50 at best. Whereas you buy some of the quality names like Horizon, they've got a network monopoly on their railway lines, they've got these long-term contracts, that sort of quality, and it's cheap as well because it's got a cash flow yield of, in the low double digits. That cash flow multiple and a cash flow yield in the high single digits, that kind of thing, that's quality business that's cheap.
Do you have BHP in your portfolio for the dividend?
No, because the dividend depends on the commodity price. The commodity price depends on effectively iron ore and copper. Those are both very elevated. Small drop in demand, and those commodity prices can fall a lot. I was around in 2008, as were you, and we saw initially early 2008 the GFC was starting. Oil price went to 150, but in May. It was under 30 by November, and the effect of that price fall is magnified on the commodity producer because their costs don't really change.
Yeah. Hugh Giddy, thanks for joining us.
You're welcome. Thanks, Peter.
David, welcome to the program.
Great to be with you, Peter.
So let's talk about, it's a great report. I'm sure you've been the numbers man, you'd be happy to have a report like that. Well, what are going to be the makers and the breakers for the outlook that's determining where you think this company's going?
Well, let me start, Peter, by actually acknowledging it was a significant half result. It was a record performance for the first half of the year. And a lot of that was driven by strong prices, and that leads us back to China as a key customer of ours. And clearly what we have seen is a little bit more resilience coming back into the China economy, alongside real estate, alongside credit access, and that's playing out in how we're seeing the underlying demand for our products and the prices that we've been able to realise.
I guess in trying to work out what are going to be the main drivers of success for the company going forward, you also have to, clearly you have to work out where you think China's going, but also what about your competitor in Brazil, namely Vale? Do you take into account what they might do in terms of supply over the course of 2022?
Look, we certainly do, and it's important to acknowledge that as the lowest cost producer in the iron ore market, that puts us in the best position to maximise the outcomes that have come from pricing. So a really strong operational performance underpinned the record result. Clearly what we're looking at is supply and how that plays out, and Vale over the period of time have had some supply interruptions which has tightened the market. Best way for us to actually access that is continue to focus on what we can control, which is operational performance and being low on the cost curve.
Okay. You mentioned China, and China's got a role to play in terms of costs and inflation. How important is inflation going to be to the performance of the company going forward?
Look, it certainly is a factor. We're focused on the fact that inflation has some lag effects, but let me just sort of break that down a little bit further for you. We see two sides to the equation of inflation right now. There's tightness in the supply chain market, which is having inflationary pressures. Now, some of that we would see as being transient and ultimately should be able to work their way out of the system. And then the second side of the inflation aspect is very much demand driven. So this is having input cost pressures in relation to explosives, in relation to diesel prices and in relation to prices primarily. But on the other side of that, that's actually meaning that we're getting higher realised prices for a number of the commodities that we produce. So net, that actually means that we're growing our margin. And our EBITDA margin for the half was a very healthy 64%.
I didn't think about asking this question, but if I was you, I certainly would have an answer to it. Have you made your best guess around what the Fed might do with interest rates in the US? Because if they raise, say, 7 times, and the first one is 1%, as Mr. Bullard suggested, which I don't think will happen at all, that will have a certain impact on, I reckon, global demand and whatever. Have you tried to work out what is the best case scenario over there?
Look, we're certainly focused on it, and as you mentioned earlier, if you look at the inflationary aspect in the US at, let's call it 7.5% running at the moment, That's something that we need to consider. We certainly think that ultimately wages are behind that, and so we're paying attention to whether wages will catch up and how that could play out in the overall picture. But I would also just say to you, at the moment in the US, if you look at households, wage increases haven't been keeping up with inflation, but they also have a large amount of savings at the moment. So how people look to spend that money will also be a contributing factor to see how demand plays out for ultimately the commodities that we see and ultimately the products that are produced from those.
Yeah, well, David, when you and I had a lot more hair, we never ever thought you buy a mining company for dividends, but over the last few years, you've kind of turned that generalisation on its ear. Is the dividend looking pretty safe for another year?
Look, again, if you just look at the last 18 months, including the dividend that we just announced, we've delivered $22 billion to shareholders. And that is a substantial return to shareholders. Now, moving forward, we will continue to ensure that we apply our capital allocation framework and reward shareholders appropriately, understanding that we need to continue to also reinvest back into the business and maintain our resilient and strong operational performance, but at the same time look to grow the organisation. So it's always a balance. It's something that the board with management look at every 6 months to ensure that we're actually rewarding shareholders appropriately.
Yeah, what about, you're talking about growth, are you thinking about an acquisition along the way?
Look, in relation to growth, we do look at mergers and acquisitions as one lever, but we also have other areas that we continue to focus on as well around how do we actually grow organically as well. Now, whether that's early stage entries, whether that's using innovation and exploration, and making the most of the resources that we actually have already in our portfolio. But M&A is something that we consider, but we'd only look to do that if we can see that that's ultimately adding to shareholder value.
One last one, mate. Omicron's been a curveball that all businesses have to deal with. Have you guys, done some analysis on whether you think there's going to be a continued challenge to your business from, either Omicron or other variants?
Well, certainly we have, and over the last 2 years, the strong operational performance is a demonstration of how resilient we can be in the face of COVID. And certainly the Omicron side of things is one aspect, but I'll take you back 2 years ago when we were seeing high levels in Chile, as an example, at our operations there, and we've been able to adapt our processes and continue to operate effectively and efficiently throughout this period. Now, there's lessons that we've learned out of that. I mean, in the last 6 months, we were seeing 15 to 20% absenteeism on the eastern seaboard of Australia in our coal operations, and yet we're able to adapt to ensure that we're able to continue to deliver product safely, most importantly, but also meet our production outlooks.
Okay, David. Well, we tipped you look like good value at $35. Just keep up the good work, please.
Thank you, and certainly appreciate your interest.
Cheers, mate. Thanks very much.
Thanks a lot.
David Lamont, BHP. Well, it's time to have a look at reporting season. It's been a big week this week. So I've got Paul looking at the major companies, what they've basically told us about their company going forward, and whether they are buy, hold or sell. Paul, good to see you.
Thanks, Peter.
Let's just start with BHP. It started off the week in a big fashion and the market's been pretty positive ever since.
Oh, the BHP's a buy. Probably remains a buy still, Peter. That was a great result. Look, it's not doing anything wrong. That's the most important thing about BHP. You've got great fundamentals and commodity prices are still more on the up. They were pretty bullish about the outlook, and BHP's now the biggest stock in the index. I think we're going to see more passive buying.
So fund managers really have to buy.
Yeah, they have to. It's getting up towards 12%, Pete, and they can't not hold it. It's too much risk for them. So I don't think we've yet seen all that. That's my sense. Okay. And so dips for BHP are going to be bought.
Yeah, and we actually have.
Well, I think it should add. It's yielding over 8%, right?
Yeah,
and
so
it's
dividend chasers will buy it.
So you're going to get a dividend of about $2.10 for that on that half year. And look, as long as BHP doesn't do anything stupid, right? And by stupid I mean do a huge acquisition at the top of the cycle. That's what I'm really worried about BHP. Okay. They've got to do some acquisitions.
They've done that historically.
But that I might change my view, but I think dips and BHP are going to be bought.
Okay, right. Let's go to another big, very impressive company, CSL. We've liked it. It's had a nice rise this week. Was it purely because of the report?
Look, I think so. I mean, I think they got too negative. Yeah. I mean, I was surprised by the market's reaction to the report because CSL told us back on about the 10th of December that they confirmed guidance. And that's 5.5 months out of 6 months into a cycle. It wasn't too hard to work out what it was going to be, you know. Yeah. But there were some positives, Peter. I mean, they did reaffirm guidance, but they included some of the transaction costs, about $100 million of transaction costs for Vifor Pharma in their sort of operating profit. And so I guess that you could say they raised guidance by $100 million. That was one thing. And then secondly, the influencer businesses did really well. And then thirdly, they showed some data that said that basically, plasma collections are back on track, that they're almost back to pre-pandemic levels. Yeah. Now, CSL's always argued that it can basically, from as much plasma it collects, it can sell the product for. Okay. The lead time from collection of plasma to the product is about 9 months. So that gives you a pretty strong forward indicator of what the CSL's profitability should be in 9 months' time. And the market liked that. They were still worried about plasma stuff, and CSL said, look, we're basically on track.
Yeah, I liked CSL, particularly when the price got to $245 or something like that.
Yeah, I think the market got too bearish, and I'm not really sure why, but it just got tagged in sort of the high growth, high multiple, got caught up in that, and that's why it's rallied. It's back up, it's about $30 it's added since last week, which is over 10%, about 12% in the space of 3 or 4 days.
I was teased by one of our viewers, Anton, and about my support for CSL, and you too. Yep. You copped it as well. Yep. And I had a bet with him that by the end of this year we'll be looking a lot higher.
Well, I got berated by a couple of people for participating in the share purchase plan, and they said, well, why do we buy at 253 when it's now down at 243? Okay, well, it's now 273, right? Well, you can't always get your timing right, but you got to companies like this. You got to buy for the long term. I don't buy CSL for the trade, right?
I buy in the dip.
And I'm never going to pick the bottom, right?
No.
I think that's not the you don't expect to buy at the bottom, but you do expect it to demonstrate what it is, and it's a quality company, and it usually produces a quality report, and
it's another buy. It's another buy.
Yeah, and I still think it's a buy. Probably.
Let's go JB Hi-Fi now, Paul. We've always liked this company. We've always liked it when the price is low.
Yeah, look, an outstanding buy, and not because of its result, but because of its off-market share buyback. This is an absolute gimme, right, for zero rate and low rate taxpayers. Yeah. That's why it's got jumped by more than.
But not for high taxpayers.
Not for high taxpayers. Price will come back off following next Tuesday, right? People have been buying it to participate in the off-market share buyback. Is because the super low capital price for this means a huge fully franked dividend. And it's guaranteed at least 100 shares, and that's why it's been going up. So expect the price to come down when it goes effectively ex-dividend, ex-buyback entitlement at the close of trade next Tuesday. But it's done really well. It did report okay as well, Peter, and it was fairly upbeat about what's happened in January. So look, nothing negative, but primarily it's gone up because of the off-market share.
So would you say it's a buy for this year, but you don't expect it to shoot the lights out in terms of share price?
I think the price will come down after next Tuesday a bit, and then I'd be looking at it. I mean, I'm a huge JB Hi-Fi fan. It's the best retailer in Australia. There's nothing close to it. But 45 to 55 is sort of my range. I'd be looking a bit lower.
Okay, let's go and look at Telstra now.
Yeah, look, again, it's a bit hard to. The Telstra reported as expected.
Share price is down.
Share price has gone up a little bit. I think it's because there wasn't any new news. There wasn't, and they lost a few customers in its fixed business. But pretty well, it's reaffirmed guidance. It's on track. It had a positive earnings, adjusted earnings growth in this half versus the previous half. So it's we're seeing the first earnings growth in Telstra in over a decade.
That's historic.
Yeah, it is historic, and look, they're getting there, right? I mean, it's not going to shoot the lights out, and I think maybe $4 you could say fairly fully priced, low risk stock. Yeah. But I reckon back at 380 we'll see it out, Pete, and because it's almost a bit like an annuity stock now.
I feel it's a hold for me, and you and I got in a lot lower when we liked it, but. I wouldn't be surprised if it goes a bit higher over the year, but it's more to me like a hold. Let's go and look at Wesfarmers, Paul. Copped a bit today, didn't it?
It did cop a little bit. And again, I don't think it was anything too surprising in Wesfarmers' result. It's just that, it's obviously COVID has impacted sales performance. So
in the retail space.
Particularly, in the traditional retail of Kmart and Target. It does rely on foot traffic. We were discussing just how much online business. Sure, there's a lot of click and collect, but they had store closures and severely disrupted things. So sales are down.
Enough.
Even even Bunnings earnings were very fractionally down. And in Officeworks, no surprise, people aren't working in offices.
Yeah.
So
I guess even the cost of stuff at Bunnings has probably gone up with all the supply chain issues. Yeah.
So I mean, I don't know whether the market might have just perhaps got a little bit, been expecting too much. Yeah. And I don't think there's anything negative in the result. I think it just that the market perhaps, it looked at the result, dividends down a fraction, earnings are down, and perhaps people are saying, well, okay, Wesfarmers is trading, trading at a pretty expensive multiple.
What price would you buy in, Paul, if you weren't holding it?
Look, I'd be in my portfolio, but I think back around $50. I think it's sort of a $50 to $60 type stock. And whenever it gets in the high 50s, I get a bit nervous. It's not a super yielder, but there's some positives. I mean, Wesfarmers is making good long-term investments. I think it bought Galaxy Resources for the lithium. That's going to be a good long-term play.
Future business, yeah.
It's Wesfarmers. It's industrial business and sort of resources aligned business is going to do better this year. You can look at the takeover of...
They bought Kidman, not Galaxy.
Sorry, Kidman Resources. Sorry,
I'm glad I was listening to you.
API, the pharmaceutical business could be interesting. So it's making positioning for the longer term. You can argue, but try Bunnings overseas.
one
it
day
didn't
it'll be a
work.
$70
You can't
stock.
keep on growing Bunnings forever, so we shouldn't be too surprised.
No.
I think it's going to be a stock for the long term. Great long term stock. If the market sells off on this is probably a buying opportunity.
What about Treasury Wine Estate? It's had a good week.
Yeah,
I thought China was punishing.
I like
TWE.
TWE. I reckon this is still a buy, Peter, and I think that was a good result. And there's more in it, right?
Yeah.
And they're adjusting well to the non-Chinese market.
Yeah.
And this was a over $20 stock, right?
Yeah.
Before the whole China thing blew
Yeah.
up. I think I don't know quite. I can't remember quite the high.
No,
But it was pretty close to that, and so down at sort of near $12 is still attractive.
And I think some of our financial planning clients thought we had drunk too much TWE stuff, and when we kept sticking to it, I'm glad it's coming good.
Well, I think also they've done a good organisation. Penfolds is almost like a separate brand. They're getting, I think, the stuff in America right, and they're sort of going more premium in terms of their other brands. And look, it looks like to me it's firing. It's not, it's no roses because there was a huge market into China that's gone away, and they've got to replace that, and that takes time. But
Here's a hard question before we wrap up. Is there any stock you've seen over the last couple of weeks that you want to sell? Because everything we've talked about, we want to either hold or buy. Is there a stock out there that you've...
I'm worried. The tech stocks are coming, Pete,
Yeah.
and I think that's next week when we see the likes of WiseTech, Altium, Appen, and a few others. We haven't seen the tech stocks, so I've really got to
Zip as well. Yeah.
Zip as well. We've really got to see them to see, maybe change my mind. So there haven't been too many disappointments. I mean, if you look at it, the financials.
But you're even supporting AMP in a little, and you've always been a bit negative.
I mean, look. I'm not surprised by Origin's reaction today because I don't like Origin, but the financials have done well. So CBA, Bendigo, Suncorp, even today Challenger was a pretty good result. Yeah. The resource companies, the big resource companies, are by and large doing well. Market didn't like the Fortescue, but I just think they were just a bit worried about Ziggy and what he's doing in these TWE, what he's doing in green hydrogen and stuff, but how much money kept getting ploughed into that. But resources are doing well, financials have done well. The weakness has been a little bit of consumer discretionary, but that's how much of that is COVID. Yeah. So we've got to watch that. We haven't really seen the tech companies come through yet. So that's next week. Yeah. And I think they're the ones I'm most worried about. But let's see how they report. Overall, you've got to say reporting season's going pretty well.
So far, so good.
Yeah.
That's Paul Rickard of the Switzer Report. And that's the show for tonight. Thanks for joining us. Don't forget, if you want more in-depth analysis of companies that might be worth either buying or selling, go to switzerreport.com.au. Thanks for joining us. See you on Monday night.